Hey everybody, it's Canadian Finance Guy here. Just wanted to go over a couple dividend ETFs, a couple of popular dividend ETFs. The first one being VYM, that's a Vanguard High Yield Dividend ETF, and VIG, the Vanguard Dividend Appreciation ETF. Just going to do a quick overview and a comparison of both of these. So let's go and search the first one up. That's VYM, and I'm here on the Vanguard website. So VYM, the Vanguard High Dividend Yield ETF, let's click that. Ticker symbol VYM. If we scroll down, we can see the management style. It is index, meaning it's passively managed and tracks an index. Passively managed meaning there is no person actively buying and selling the stocks in the underlying fund or ETF. It is managed on an index style, tracking a specific index, trying to follow its performance through the use of algorithms and set criteria. Here we can see it invests in large market capitalization value stocks. Stocks only, no bonds in this ETF. Risk reward, it is a level 4 out of 5, meaning it's a little on the riskier side, but if you're okay with short-term volatility, it might pay off in the long run. If we scroll down a little more, we can see it's up 2.55% year to date. That's great performance so far if you compare it to the S&P 500, which is down, I believe, 15% year to date. Expense ratio 0.06, very, very low expense ratio. Expense ratio is expenses that the fund pays for running the fund, such as things as administration, audit fees, and other types of fees that need to be incurred in order to run the fund. So expense ratio of 0.06 means you're paying 6 cents for every $100 you have invested in this fund. Super low, super cheap, amazing to see. Vanguard ETFs are some of the cheapest around. If we scroll down a little bit more, they give us some key facts. Here, the minimum investment you can see is $1, so very accessible for a lot of new investors or people with not as much capital who are just looking to get started. Scroll down, we can see the summary. It seeks to track the performance of the FTSE High Dividend Yield Index, so that's just the index that it is trying to track. It's a convenient way to track the performance of the stocks, and they are focused on above average dividend yields, and it's a fully passively managed replication approach. That is why your fees are so cheap. Performance and fees, if we scroll down, we can see VYM. They give you different annual performances that it's had over 1 year, 3 year, 5 year, 10-year terms, and since inception, since 2006, so that is about 16 years, it's returned about 8.12%. That's great to see. Scroll down, here you can see the expense ratio compared to average expense ratios of other funds. Very, very cheap, like I said. Let's keep going. Now let's look at the price. That's the market price, $112.49 as of today. Keep going, there's some other information. Now let's look what's actually in this fund. So they give us a portfolio composition and characteristics. 442 stocks in this fund. Earnings growth rate of 11.1% over the past 5 years. Price to earnings, that is the price of the ETF, which we saw is about $112, divided by the earnings per share of the underlying companies within this ETF. It's at 14.3. There's some more information on return on equity and zero forward holdings there. There we can see what they call the turnover rate at 7.7%. So that is the amount of turnover within the companies that are held within the fund, meaning that 7.7% of the companies are rotated in and out over the years. So not super high. Most companies, 93 to 92% are being held within that fund year over year. Scroll down, we can see, like we said before, the style. It is a large cap, investing in value investment style companies. Here, Vanguard gives you some more, background on the risks associated so you can determine whether this fund might be right for you. They say if you have a long-term time horizon of 10 years or longer and you're seeking growth in capital as your primary objective, this fund might be right for you. If you scroll down, you can see different sectors here. 3.60 in basic materials, 8.60 consumer discretionary, 12.7 in consumer staples, 11.2 in energy, 20.2 in financials, 15.20 healthcare, 10.40 industrials, 5.90 in technology, 4.6 in telecommunications. So a wide diversification of sectors here. Let's scroll down and see what the holdings are. So this is great. You can see what the holdings are. First, we have ExxonMobil. Let's scroll down a bit and see the percentages. So the amounts of percentages of the companies held in this fund: ExxonMobil at 3.31%, J&J, so Johnson & Johnson at 3.28%, JP Morgan 2.63%. Great company. I have it in my portfolio as well. Here we have Procter and Gamble, Home Depot, another one I have in my portfolio, AbbVie, and we have Merck. You can just scroll down and click next page, and you can see all of the holdings in this fund. So it's great to see, you can fool around with this. I encourage you to play around with it, see all the different holdings in here, Pepsi, Coca-Cola, Walmart, McDonald's, Cisco, Broadcom, a lot of well-known companies and great dividend payers. So that's this fund. Now let's go look at the other fund. Let's search for VIG. Vanguard Dividend Appreciation ETF. Let's click that. So here we can see ticker symbol VIG. Again, it's a passively managed fund investing in large cap stocks. Same risk and reward scale. However, year to date, the returns are worse at minus 7.15%. The expense ratio is very similar at 0.06. We keep going down. Minimum investment, $1 again, very accessible. Here, though, the product summary, you can see that it seeks to track the performance of the S&P U.S. Dividend Growers Index. So it tries to pick companies that have a record of growing their dividends year over year, as opposed to VYM, which had a lot more mature companies which grow their dividend at slower rates but have a higher starting dividend yield. Performance and fees, we can scroll down and see, okay, so this fund has, since inception 2006, has returned a little bit better than VYM at almost 9% per year over the past 16 years. So again, very similar year over year, but minor differences. So I'll let you compare those two. If we keep going down, price trades at 157. We can keep going. Portfolio composition. This is where there'll be some major differences. So fewer number of holdings here, 289. Earnings growth rate is at 15.5%. The price to earnings ratio, it's higher here, you'll see. And this is because you're paying more for higher growth or higher expected growth companies in this case, and they expect to grow their dividends at higher rates than the companies held in VYM, which are seen to be more mature dividend-paying companies. Turnover rate, now it's 25% here. So this is to be expected because you're not holding as mature companies. The amount of companies in here or the amount of high dividend growers in here are going to be churned out a little more than VYM. So that's something to definitely be cognizant about and think about when you're investing into this fund. Scroll down, we can see the investment style. It's a mix of large cap, value, and growth companies. So here, the risks, again, very similar to VYM. Sectors is going to be a little different here. Consumer discretionary at 9.10, consumer staples 3.6, financials at 15.2, healthcare 16.5, industrials 13.5, technology at 22.50. So a lot more concentration on technology here. And I'm pretty sure we know what's going to be in here. It's going to be Apple and Microsoft as they grow their dividend at high rates, but they have a lower payout ratio. So we scroll down and see their holdings. We can see, okay, they have United Health Group as their number one holding at 4.4%. Johnson & Johnson, 3.87%. Microsoft, 3.38%. JP Morgan, again, 3.13%. Visa, 2.78%. All three of the last holdings, Microsoft, JP Morgan, and Visa, hold in my personal portfolio. Procter & Gamble, Home Depot at 2.6%. MasterCard at 2.38%. Pepsi, Coca-Cola. If we scroll down, we can see the next page of holdings. Costco, another one I hold in my portfolio. Great company. Walmart, McDonald's, Broadcom. So you can definitely go and see the different holdings in these companies and compare, which one of these might be right for you. Are you looking for a higher dividend yielding ETF that can give you secure income now? Or are you looking for an ETF that might give you a little less dividends right now, but has a higher growth rate, and over time will end up providing you with more growth in your portfolio? Or maybe you want to do a mix. Maybe you want to have some in a portfolio such as VYM, or you want to have some in the other ETF, VIG. So definitely something to look at. I encourage you to look at both. They're both great ETFs held by Vanguard, and they both serve a specific purpose. So again, I hope you enjoyed the video. It's really more on your investment style and your risk tolerance and what you think would be appropriate for your situation. So I hope you enjoyed the video again. Thank you, and I hope you have a great day.